Andrew, how likely are Fed officials to raise interest rates at the end of this year, and what data and signals are they looking for before pulling the trigger?
So, Noni, in this statement, more so than others, the Fed was very direct in their language about the closeness with which they came to actually raising rates this time around. They actually inserted a few sentences describing that. They had not done that in the past. And actually this time around, you also saw 3 voting members of the Federal Reserve dissent, meaning they did not agree with the decision to not raise rates. Among those 3 included Eric Rosengren, who typically had been associated with a dovish stance, meaning he would support rates remaining lower for longer. So you can see they're getting closer to broader acceptance of the idea that they could move going forward. In terms of data points that they're looking for, Janet Yellen mentioned several times that they were pleased with progress made, particularly on the labor market front. She actually acknowledged that there has been a bit of a slowdown in jobs numbers. Rather than the 200,000 plus we had been seeing for the better part of the last 2 years, they've actually slowed around 180,000. And that's actually enough, more than enough to account for all the new entrants in the labor force. So that actually means that people are coming back, right? Rather than just new people entering the labor force, people are coming back that had not been there before. So again, they're very pleased with that. So if you were to continue to see job numbers, not even at 180,000, maybe even 150 would be enough for them to justify a move sometime in December.
And what about 2017 and beyond? Should investors expect 1 rate hike per year going forward?
Depending on how much credence you put in the summary of economic projections, and these do change over time. They've actually changed again with the September release. They've brought down the number of expected increases in 2017 to 2. It had been somewhere closer to 3 or 4. And they've brought down what had been an expectation of 4 increases in 2018, brought that back down to 3. Right? But we think in addition to that pace, it's also very important to look out at the longer-term terminal rate. So what is the rate to which they believe they're going to achieve, quote-unquote, equilibrium in the long term, right? That had started out as high as 4.5%, and maybe even as near as 2 years ago. That's come down in each one of these projections, such that now it actually rests a little bit below 3%, and we think that was very important to that end as well.
I think it's important for the markets as well that the Fed this year has lowered their expectations for how quickly interest rates will rise and where they'll end up. One of the problems that the Fed had last December when they first raised interest rates was that they had promised to lift rates fairly quickly. And markets, I don't think, like this very much. What we saw was that the US dollar strengthened to such an extent that we saw some capital flows coming out of emerging markets. And also with that sort of aggressive pricing of interest rate hikes, that's hurtful for any foreign countries who've borrowed in US dollars. So I think this year, if you have sort of a more steady increase expected, that should calm the markets, and we hopefully won't see the sort of negative market reaction and sell-off that we had in January of this year.